All right, guys, we are back from the break. Do me a favor, just quickly raise your hand. Didn't actually do this before to make sure you are hearing me. There's a raising your hand feature in the chat. Okay. And obviously, I know you're hearing Mark because otherwise I'd be hearing uh, everybody chatting in there. By the way, just a quick throw out to Renee, who is here for her third time, absorbing new nuggets, as she says. And she's thanking me for twisting her arm to come back for a third time. So you're welcome. And some of you may be familiar with that feeling as well, because I know some of you I had to talk to and really force you over the top. But ultimately, you hopefully will be another one of understanding why I am so passionate about what we do here. With that said, we're going to get into fundamentals starting on page 63 in your workbook. This section should last about an hour, 20 minutes, 25 minutes, and then we'll have a 5-minute break before the last section. So let's get back to Mark and Mark.
Okay, guys, welcome back. We're going to continue with our day one here of Master Trader Program. And I want to first recap of what we just went through, what we just discussed. First of all, we talked about categories and catalyst, the various categories, the market leader, the top competitor, institutional favorite, turnaround situation. We talked about valuation, or the lack of valuation being a metric that we use. And again, we can look at the valuation and get an idea of whether the stock is has a lot of expectation or not, but certainly using it for any type of pinpoint timing indicator, or even to know if it truly is undervalued or overvalued, is really hard to measure with like a PE ratio, simply because the market is a discounting mechanism. And I'm going to show you in just a little bit here how that translates into opportunity. And then also we spoke about the trend, non-negotiable criteria, and how we're not going to trade a stock. We're not going to get involved in the stock unless it already meets that qualifier, where we're in a stage 2 uptrend. At the very least, it's meeting the early turn criteria, where you've got at least a month of upturn in the 200-day or above the 200-day moving average, and so forth. So now we're going to get into fundamentals, which we call this section fundamentals to focus on. I talk about a lot of this in my book, in my first book, Trade Like a Stock Market Wizard. There's a section on fundamentals. In my second book, there is no fundamental discussion. So that would be the book to read. Some of you might have already prepped for this. I'm going to go over a lot that's in that book, but we're going to flush it out even more. And I think it's going to be very interesting. The thing about fundamentals too, and again, I swing trade, Mark Ritchie swing trades, and if your time frame is really, really short, the fundamentals are going to mean less and less to you, because you're not maybe holding for several quarters and going through earnings reports and so forth. Certainly, going through an earnings report is a fundamental that could affect you drastically if you're holding into an earnings report, that you get a bad report and it gaps down. And we'll talk about holding into earnings later on. But again, if you're going for the bigger moves and you're going to, you want to be in the best names, you want to have it all. You want to have the fundamentals, you want to have the price action, the trend. And when you put all these things together, you have a much higher probability of spotting a big winner. Now, I just want to point out, because some people, they'll notice that my trading, or I talk about swing trading and some of these shorter term trades, which we'll get into later on too. And then we talk about finding these big winners that make these multi-year moves or tens of thousands of percent. The one thing that's very important, a distinction about how I trade, at least, whether I'm going into a stock, and this is really what specific entry point analysis is all about, for me at least. If I'm going into a stock for a short-term trade, even if I was going in for a one-day trade, I was going to scalp the trade, I'm going into it for, it's a market, maybe a potential market leader in a new bull market after a bear market, and I'm planning on trying to hold it for a big move, I'm buying at the exact same point. Regardless of the fundamentals, which we're going to talk about here, this is all underlying conditions that are going to build a case for the stock, if you will. I'm still buying at that same spot. And remember, we talked about reference points. The reason why I do that is because I know I'm a master at knowing what to expect under specific conditions. I've basically created this, this strategy that I have. So under certain conditions, I know what's normal, I know what's abnormal, and I've become an expert at that. So I stay in my own area of competence. So it's real important. And we're gonna talk about that later. All these things that I'm telling you are going to make sense as we move through the curriculum and as we get through the days. You're going to see how everything I'm telling you, there's a meaning behind it. There's a reason behind it, and you'll pull from it later on. Mark, you made a comment about that earlier, about how all this is important and it all is relevant.
Absolutely, yeah. My experience early on, Mark, was, you talked about, being, more maybe a shorter term trader, and I was a little bit more focused on the technicals. And a question we both get a lot is, so are you technical oriented or fundamental oriented? And we usually say both. We'd like to see both, but when it comes to the really precise timing, which we're going to get to, we're certainly going to err more toward the technicals. But what I noticed in my trading, again, as I studied my own results, was that even on a shorter term time frame, often my best trades even were in situations that either had the type of fundamentals we're going to be talking about on the table. Well, that's because that's what institutions are, accumulating positions in. That's what's giving it that nice tailwind. And then ultimately the technicals we're looking for as well.
Yeah. I used to always ask David Ryan when he was my co-instructor. I'd always ask him each year, I'd say, Dave, in all the years that you were with Bill O'Neill, how many times did Bill O'Neill buy a stock that was losing money, or a company that didn't have fundamentals on the table? They didn't have good fundamentals. He said he never saw him do it once. So there's a great example of, if you're going to play for those.
David would say the same thing too. He would say that himself. How many examples did people ask him, David, what do you think of this stock? And he goes, there's no earnings. He would say that every time.
Yeah, even with the biotechs, you go back in again, one of the most famous biotechs, certainly that I purchased, David purchased, and Bill O'Neill purchased around the same time, was Amgen, and it had earnings on the table at the time, back in 1990, going into 91. Now, I do trade stocks that don't have earnings, and usually they're in biotechs. But what we're going to show you here is I'm going to show you how this creates opportunity, regardless of, and it's going to put it all into perspective. It's going to put it into perspective, the companies that don't have earnings, the companies that do have earnings, and the main thing, and what we want to understand is what attracts institutional money. What is going to bring the big money into a stock and support it in that uptrend? That's the real key. And like I said before, the real secret to this whole thing, or the advantage, I should say, that you have, is that you can know that information. Now I'm going to give you all that information, right? The same information that I gave to the big institutions years ago, when I only advised institutions. And you'll have that information, but you'll be able to act on it much faster and be much more nimble. And you'll have the same tools and be able to apply tactics that are even much more effective because of your relative size. So let's get into this. And we're going to build some perspective here, and then we're going to get into some more specifics. But the thing I want to point out is that as I go through this section on fundamentals, I'm going to talk about a whole bunch of ways to look at them and slice and dice them from different angles. But we're only going to be talking about, and in my work, I really only look at, I look at a bunch of things, but I really weight 98% of everything I do is weighted in the fundamental area around three things: earnings, sales, and margins. That's it. No book value, return on equity. Some of these other metrics need to be compared industry to industry. Software companies can have bigger return on equity than a company in a different industry. So the three things, though, that are pretty much constant, and you can go all the way back to the 1800s, early 1900s, what drove Coca-Cola back in the early 1900s drove Monster beverage. Okay, nothing different. Sales earnings margins. That's what we're going to look at. We're going to slice and dice them different ways. There's only 3 ways that a company can increase earnings, and that is to either sell more of an existing product, raise their prices, sell new product, or cut costs. All right. So that's 3 ways: sell more, raise prices, or cut costs. Sell more of an existing product or sell a new product, raise the prices on your existing products, or cut costs, which could be you're getting rid of losing operations, you're streamlining productivity. That's another way. You're not cutting costs, but you're more productive. But here's the thing you have to remember: that cutting cost, ridding losing operations, streamlining your plant can only go so far. There's only so much you can cut costs, and then you've got to produce revenue. So revenue is really important. All right, you have to keep that in mind. Now, sometimes you'll see earnings. All right, you'll see big earnings come in, and you'll take a look and you'll see the profit margins are up, but the revenue's flat. The revenue is not doing very well. Well, that's because they're making more. They're making larger profit margins now, but they're not growing their revenue. So you could have flat revenue, grow your earnings by your profit margins expanding. But when you see that situation, that's a more tradable situation, because you can't, you've got to have revenue. You can only go so far on increasing profit margins, right? So the real power comes when you get it all. When you get revenue growth and you get profit margin expansion, these are the companies that are really doing great things. They're not only have some kind of product that's selling really well, but their management is really good, and they're improving their productivity. Their margins are widening. This is where you get explosive potential, and we're going to talk about that here. So we talked about the maturation cycle of the stages, right? Where you go through, and we want to be in stage 2. Remember, we only want to be in stage 2. Well, the fundamentals, somewhat, not perfectly in line with the stages of the stock. There is a discounting mechanism of stocks, but basically you're going to have the cycle of the earnings maturation cycle is going to go through a 4-stage process too, where you're going to go from maybe a stock is a value stock, or it's out of favor, it's in that stage 1, it's nothing to write home about, and then suddenly it comes alive. And usually that's because some surprise happened, something changed, some improvement in the business. You have a lot of computers now where you'll have these computer models, and prior to computers it was done by hand, but you'll have positive surprise models. They'll kick in, and then estimates get revised up, and then you get earnings momentum. As the company delivers these earnings, you get earnings momentum. And remember, I talked about that official growth stock. This is where, again, where you'll see it in earnings also, where you'll get to a point where the earnings are really solid and they're consistent and you can count on them. And the dividend's been being raised for a number of years. And then you get a loss of earnings momentum, and the negative surprises come in, and then the negative surprise models kick in, and this is where the stock, if it hasn't already gone to stage 4, it enters into stage 4, and you go through, and it's right back to being a stock that's out of favor. And in stage 1, it could, and sometimes for years or even decades. So this is the maturation cycle. Just keep that in mind. And
Mark, I just want to add go to that slide real quick. We mentioned in the last section about how some of these stocks, that when we use the phrase, they're marching to the beat of their own drummer. This is because they're in this part of the cycle in terms of stage 2. So when we talk about a stock that's in its own maturation cycle, what we mean is, and I think we use the example of Apollo, or even during a bear market, this stock was having positive surprise and estimates revised up, and still had EPS momentum, was able to even buck, the pull of the overall market. And that's why this slide is really powerful, especially for those of you guys who want to play names for bigger moves. You have to understand this concept.
I think that's a great point, and that it keys off of, yes, some of the previous examples. And what Mark is saying is that you don't have to have the overall market in a stage 2 uptrend. All right. And in some cases, although you would like the market, ultimately, when you're getting a lot of stocks doing well and you're making a lot of money in the market, you're in a bull market, the market's doing well. However, a lot of leaders emerge in bear markets before the market even makes its low. And we've showed you some examples where you were in terrible markets and the stock still went up significantly for months and years. So not that we want to, get super aggressive in a bad market where there's not many stocks, and we're only seeing a few stocks and trying to pick that needle in the haystack, but it just shows the power of being in, as Mark said, in your own earnings cycle, when those earnings are coming in really strong, those are the names that, you know, have real staying power. That this is driven by earning surprises. And again, nowadays, you know, earning surprises are, you know, what is the real surprise? You know, you've got the whisper number. You know, it's not as easy as just looking for a stock that has better than expected earnings. But when you go back and you take a look and you look at the stocks that are performing consistently, especially against a weak environment, you're going to see that the earnings are, there are surprises in there. And that stocks move basically because of conditions improved and are better than expected in some way, shape, or form. Now, we don't look for earning surprises necessarily. There has to be a number of earning surprises, like a Zacks model or something, which is not a bad model. It's actually a very good concept of using earning surprises as selection criteria. But like I said, you will be driven by earnings as something doing better than expected. And what this creates, it creates what's called post-earnings drift. And it simply means that, and again, I'm going to get to a really important point in just a minute here. I think the next slide, actually. Post-earnings drift just simply means that not everything's discounted. Now, the efficient market hypothesis says that everything's in the price. So that would mean that if an earnings report comes out today, it's either already in the price or the price will move so quickly that it will discount it and you won't have a chance to really take advantage of that information. This is completely false. And in some cases, it's true. And overall, the market is very, very random. The efficient market theory is somewhat true overall. But there are individual companies, and certainly small and mid-cap companies that are not followed very widely, there's tons of inefficient pricing. And we see this all the time.
This is a really good point too. I was just going to add, Mark, I think, you know, the difference between perfectly efficient and mostly efficient has been worth many millions to both of us.
Yes.
And the idea being, yeah, we want inefficient pricing, and this is often, you know, where you're going to find it.
And we're looking for inefficient pricing. I was just going to say, Mark Ritchie is an expert in recognizing this, even without fundamentals, even looking at the charts. And we're going to go over that later, assessing alpha and going in those areas that are showing very efficient price moves with little volatility. This particular slide right here, though, and there's a little golden nugget there. We put a few golden nuggets here and there when we get to something that's really, really important. This makes a huge point here, and this is really the whole reason why there's this great opportunity in the market, and the reason why I've been able to do what I do for almost 40 years and consistently be successful, and Mark Ritchie and so forth, and Bill O'Neill and so many others. The way it works on Wall Street is that as companies do better than expected, you've got analysts that revise their estimates. They assess the company, and then they give these estimates of where they think earnings may be. Now, all these people, you'd think all these smart people on Wall Street and these tons of MBAs and PhDs and computers analyzing all these companies, you think they'd be able to be really accurate and peg this stuff, right? Even in the most widely followed companies like a Coca-Cola that have 100 analysts following them on the street. What happens is that for a couple reasons. One would be purely just skill. Two is to protect your job. And three is the nature of large numbers, which I'm going to show you in just a second here. What happens is that the estimates are actually revised very slowly, and they're revised conservatively because nobody wants to be the rogue that comes out and makes some outlandish prediction and be wrong, because their job is on the line with that type of analysis. So everybody sort of gathers around the mean, and nobody wants to make a real big move until it's obvious. And that's why you see a lot of these brokerage recommendations stuff. They'll be downgrading when the stock's, after it's down huge and near the bottom. They'll be upgrading at when the stock tops, and they're always behind the curve because they're moving very slowly and conservatively. Now, But here's the real secret here. And that is and it goes back to earnings. And even if there aren't any earnings, it either the big earnings on the table or the potential for big earnings. For instance, a biotech doesn't have, sometimes they don't have any earnings or sales, but there's an enormous potential for maybe a blockbuster drug that can do billions of dollars at 80% profit margins. So that is what the stock is discounting. So what happens is when you get very large numbers, so for instance, Cisco Systems, all right? Cisco Systems had a huge run. It's one of the biggest winning stocks of all times. They had 16 quarters of triple-digit earnings. Now, when you have those type of earnings for that length of time, even looking out, let's just say, and I'm going to go back to the previous slide on page 68, even looking out just a few quarters or 1 year, the CEO himself cannot tell you that they're going to have triple-digit earnings 4 quarters from now. Nobody could know that. So, and this is why when you get this super high PE, it doesn't really represent the true valuation when you have big earnings. If you have a company that's growing really slow, you got a grocery store and it's growing at 4% a year, yes, you can get a pretty good idea and the visibility is going to be a lot better. That's why there's no opportunity there. But when you get some software company or some companies on the cutting edge of a new technology, like when the internet stocks came out and nobody had a clue as to what that meant, but there was some intelligence in the market. It did, because those stocks all doubled, tripled, quadrupled. So what happens is, as these big earnings are coming in, there's an adjustment that's made. And because of this limited visibility, the stock could just keep going and going and going because it never fully adjusts. It never can fully adjust. You're looking at, I'm going to show you the example here. This will make a case. So just imagine you had a little company that you were a contractor, a plumber, all right, and maybe you're doing $500,000 a year in business. You make 6 figures. Your profit margins are 30-40%. Maybe you're making a couple $100,000. Okay, well, in the case of Cisco Systems, which is a $100 million plus company to start with, I can't remember, they were a mid cap company back then. Let's just take $100, right, and we're going to double it each quarter for 8 quarters. They went 16 quarters, right? But let's just do 8 quarters and relate this to your own business. Maybe you're in, you're a dentist. You're, like I said, you're a plumber, right? Take your revenue, double it in 3 months, then double it again, then double it again, and keep doubling it. So in 4 quarters, in 1 year, your business would be 16 times larger. So if you're doing $1 million, in a year from now, you'd be doing 16 million. Okay, 4 more quarters, in 1 more year, you'd be doing 256 million. Now, apply that to a company that's doing 100 million, $1 billion, and you can see how an Amazon can become an Amazon. And so these numbers cannot be discounted. Nobody knows, but if those earnings keep coming through, you're going to consistently get an upward adjustment. And that's where you'll get these opportunities, because along the way, the stock will correct, it'll pull back on news, it'll form a base, and you'll have these opportunities to get on board because, and this goes back to what I was saying before, where, okay, I may trade like Yahoo, I traded for 100% move, then I traded it for a 60, then a 30. I had a bunch of times, I made hundreds of percent on Yahoo. It went up 8,000%. When on that big move, it afforded me all these opportunities to go in and out of it. Now, if I held it, that would have been just as good. Who knows? Maybe even better in some cases. Going back and looking, I bought Cisco Systems right off the IPO base, and I sold it for a 5-point move. So I didn't make much money on Cisco. It went up 70,000%. But during that same period, I made over 35,000%, which wasn't too bad. So trading.
And I'll just add, your drawdowns were far less than holding for that entire move in Cisco Systems. So
that's a very good point. During that time, Amazon, which I bought in 97 right off the IPO also, which went up huge, had I believe a 90% drawdown. So the other question is, would you really have even held? Would you really have held through all those pullbacks, or would you not sold, when you were up 100%, 500%, 1,000%, 10,000%? are you really going to hold for an 80,000% move? But you can get to that big return because you're if you sell out on these trading opportunities, you're not making that big giant decision or having to come up with a way to capture a 20,000% move. We're going to get into more of that later, though. So again, we're still in. We're moving down to more of an aerial view now, okay? Because these are the fundamentals that we're going to put beneath the technical analysis. These are the things that we want to understand. One of the most important things, and my point here, it's not going to be like to go find a stock that has necessarily the strongest earnings. This is the real point right here. The real point is, no matter what I tell you about these fundamentals, as we go along, I'm going to show you ways to slice and dice them and what you want to look for, and what leads to super performance. But the important rule is that you never, ever trust the story. You never trust the numbers unless it's confirmed by price. Because again, if things are so great, the company's so great, the earnings are so great, the prospects of the future are so wonderful, why would the stock be in a stage 4 downtrend? Why would it not be? Why would it not be performing? Why would it have a relative strength of 13? There's a reason. There's a reason, because stocks are a discounting mechanism. So you're always going to end up with, you want the earnings, you want the fundamentals, but here's the caveat to it: you never trade without the chart. Now, what's the other question? The corollary to that, or the opposite of that, is: do you trade without the earnings? Do you trade without the sales? Yes, you can. You can. You could trade on pure technicals. So this is another tool, another way to stack probabilities. And we've got to go back to the very beginning. Remember, I told you everything that I talk about is going to build on what I said previous. Well, we got to go back to the beginning when I said categories. Well, you've got to know the category. Okay, so what if we're in a biotech? We see a biotech setting up, and technically it looks great. They've got no earnings. They've got no sales. Well, if you were to eliminate all the biotechs based on earnings and sales, and you would require to have earnings and sales on the table, you'd eliminate about 75, 80% of all the biotechs and some of the greatest companies ever that discovered, promising and exciting new drugs, because they're not trading on, most of them are not trading on earnings and revenue. They're trading on the FDA approval process and the prospects of a blockbuster drug, which again cannot be fully discounted there, because there's no certainty there. So that limited visibility, right? When I go back, and I'm going to bounce around, you don't have to jump around too. We're going to keep moving from the current slide that we're on.
I just want to highlight that last slide, Mark, to say, I think for a lot of folks that are new, this might be worth taping to your monitor or putting on the wall, because I've seen an awful lot of folks when I run into them and they go, well, I'm holding this stock and it's, per the last section, in a stage 3 or 4, and they should have gotten out of it a long time ago. This is usually why. They either fell in love with a story, or they got sucked into,
the numbers are still doing
well. The numbers still look great.
Looking good.
Yeah, the number still has triple-digit earnings. And this is another great example why you have to heed the technicals. And I remember David Ryan once saying, look, I buy on fundamentals and technicals, but I never sell on fundamentals. I sell on technicals, meaning I don't wait for the fundamentals to sour to get out of a position. And if, the last section on P, or the 2 sections ago on PE, should have been a good lesson why. And this is just one of those. It should be like a 10 commandments of trading. You can't fall in love with the story, and definitely don't listen to the company. Once the stock starts breaking down, absolutely don't listen to the company if they're telling you things are great. If the price is telling you otherwise, you got to heed the price.
Very good point, and that's what we're going to get to in here. Well, 1 second, I want to show you some examples why what Mark is saying is true. I fell in love with a couple stories in my day. It was luckily it was early when I didn't have a whole lot of money, but it cost me dearly. And I would call the company and talk to the the investor relations. I even talked to the CFO at times, and got this glowing dog and pony show, and that made me say, the stock's down, but I'm going to buy it because everything's good. The numbers are still coming in. So we're going to move forward. Well, real quick too, I just want to point out this opportunity is because of right here, limited visibility. That's the key. Limited visibility is your friend. That is your friend. Remember, if everything could be figured out, if we could nail down where the earnings are going to be for certain, and we knew all the information, and we had some black box system. That's why this is in large part an art. We're going to give you all types of techniques and tools and a strategy to try to eliminate as much guesswork as possible. But if we could eliminate all the guesswork and you didn't have to do any real work and have skill involved, there would be no opportunity. There'd be no opportunity. You just put it in a spreadsheet, you hit a button, the computer would pick the stocks and trade them, and everything would become efficient. And the efficient market hypothesis people would be correct. See, but that's not the way it works, because there's 10,000 names. They can't all be followed by and followed perfectly and know everything that they have to know about the future. And the big thing here is when they got the big numbers, the law of large numbers, there's no one can know that a company is going to produce those numbers for years to come every quarter. So going back to never trust the story, never trust the numbers, and why someone like David Ryan said where he sells on technicals. Now, fundamentals can go bad too, and that could be a reason to sell. But usually, the stock price will pick it up ahead of time or coincident with it. And let me show you how that looks. So, this is a term that I use called differential disclosure. I did not make up the term. It's actually used in forensic accounting, where when the forensic accountants look at, they'll take a look at the tax return, and they'll look at the quarterly, the reports that are sent to the SEC, and they'll read the annual report, and they'll look for discrepancies, and they'll look at the footnotes, and they'll look for discrepancies between those, because reporting to shareholders doesn't have any rules. There's no like SEC guidelines, but you have reporting to the SEC, you have very specific rules and guidelines. So what you say to the SEC and what you put in your footnotes could be a telltale sign, because sometimes they're very different between the things that they report to shareholders. So this is what forensic accountants will look for, and they call it differential disclosure. I use differential disclosure in a very basic, straightforward way. And the way that I use differential disclosure is I look at the price and I look at the fundamentals, and I ask myself, does it make sense? Does it make sense that this company just came out with 144% increase in earnings? It was better than the analyst expected, and the price drops 25% in a matter of hours, and it's the largest price drop it's had in the last 5 years on the largest volume, showing that institutions are piling out of it. Would that make sense? Is that earnings report really as good as it looks? Absolutely not. So you have to judge an earnings report not only by its face value of the numbers, but you have to judge it by the response to the numbers. Okay. So, and in this case, this is Crocs, and this was a clear-cut sell signal. As a matter of fact, David and Ryan talked about this many times. He was selling stock during this decline that he had held for a while. This is, again, we talked about this earlier. This is institutions piling out, but this came on the day where the earnings were up 144%. So again, looks like good earnings, but does it make sense? If their earnings report so good, why is the stock getting clubbed? Okay, so this is how we apply differential disclosure. Now, let me show you how this works in real life. What happens is the stocks do a really good job usually at discounting negative events, negative earnings. When things turn and the earnings picture starts to dim, usually what will happen is the stock will go into the stage 3 and even stage 4. And remember, I talked about how in stage 3 you look for some of those big declines in heavy volume. That's sort of giving you a heads up that the crap's about to hit the fan technically, and then fundamentally, usually it comes down the road. So take a look at Crocs here. You can see that, and these are the earnings right here. These are the quarterly earnings at the bottom here. Now, you see some deceleration. They start to decelerate, but I don't really even pay attention to deceleration if it's triple digit or anywhere near. If it's 90%, if it goes from 144 to 90, I don't really pay attention to that. That's not going to really get my attention too much. So, but this stock decline on these big earnings definitely get my attention. And if I were in this stock, I was actually in this, but I sold way before this. I would definitely be selling. I would not be buying here. And you can see this is the stock that from that point went down 90%. But take a look at when negative earnings come in. See, they come in at way after the damage has been done. Now the minus 71, now it makes sense. All of a sudden it makes sense, right? So, okay. So again, let's look at another one. This is Vicor. And again, like I said before, almost all of these stocks that I'm showing you, I was in. Now, I didn't buy it at the low and sell it at the high, but I participated usually from the buy point that I'm showing you right to the day. This was a stock that I bought. It was coming out of the 1990 bear market in 91. Huge earnings. Look at these triple digit earnings. This is what fueled this big move. Now you see it goes into stage 3. You got a little bit of deceleration here on the earnings, goes into stage 4. Then you got flat earnings. Then look at the earnings here. Look at this difference. You can see that, and this goes back to what Mark was pointing out with the earnings maturation cycle overlaying over the stage 1, 2, 3, 4 technical cycle, where you see the picture here, the stage 2, look at the earnings. Now, stage 4, look at the earnings. The difference is, though, you're going to almost always see on the up moves, you're going to see the earnings will stay. You could go years and years and years and years, decades, with having earnings and the price performing. But usually what happens is you get to stage 4 and then the bad news comes out later.
This is a good example, Mark. I mean, this last slide's a textbook one too, though. You know, one thing you're always telling folks is that, look, the market is a discounting mechanism, meaning it's looking 3 to 6 months out. So when you see this rally starts, the market is discounting triple digit earnings for a few quarters. And once it tops, the market's telling you, the price is telling you that there's no more growth anymore. Crocs was a perfect example. And sure enough, then two quarters later, the negative to slow to no growth shows up. But if you wait for that to show up on the table, this is why you have to heed the price action, because the market is looking ahead and telling you that the growth is over for now, which is why Crocs had, and again, why you'll never see the two of us ever buy a break in a stock like that, because the smart money is piling out in anticipation of low to no growth in the future.
Right, and we're not giving, right now, we're still in the perspective stage of an aerial view. We're not giving you saying these are particular sell signals, although we're going to get to sell signals. We're going to get to specific sell signals, exactly what you need to look for. And one of them, which is a late sell signal, is the largest decline on the largest volume, weekly and daily. So these would be sell signals, but you should be long gone. This would be like literally like the last sell signal, or at least to stay away from the stock. So again, the point we're trying to make here, though, is for you to understand the discounting nature of stock prices and how to take advantage of it, and the nature, just the nature of the way it works. Again, you have to have all this perspective, and then you're going to understand how to trade within this framework. All right, so real quick, just show you this a few examples. Of course, you can see here stock breaks on good earnings report, quote unquote good. 38 cents versus 37, beat expectations by a penny, 46%. Sales up, they actually beat estimates too. You see now after the stock's down, huge, comes off of, I don't know what, $80. It's down here all the way down. On this earnings report, down to $25. Now, all of a sudden, now the negative earnings. Now EPS down 24% on sales, negative 1%. See, and again, you can see the major break. You had the big major break, and that just led to a real problem in the stock. This can also happen on company-issued guidance. You might get good earnings, and they beat. For instance, this was happening with Netflix when it temporarily topped earnings of 57%, beats by 14 cents. That would sound like a great earnings report, but they lowered their guidance, and that's all that the street had to hear, and that topped the stock. Next quarter, same thing, lowered guidance. Green Mountain Coffee, some of you might remember this, similar situation where you had great earnings right at the top, but as the stock topped, you kept getting good earnings. Even you had this snapback over here, you had a big quarter up 233%, and then after the stock is imploded from, I don't even know what the price is up here, but it's a huge decline. Now 33%, huge deceleration, and now only 6%. See, the growth is gone, but the stock is already topped. So differential disclosure. Now, another thing I want to point out here, and that is that, as I said earlier, a good company doesn't necessarily make a good stock. There's tons of companies that were great companies that either went out of business or stayed down for so many years that you wouldn't have been worth being in the company because you would have lost so much time and your money would have sat there for a decade or two. So again, here, this is a perfect example. You know, if you remember Tilray, this is the Mayorana stock, right? Yeah.
Yes.
You know, the stock went up 1,000% in 5 weeks. Now, meanwhile, you know, you compare it to something like Macy's, which was founded in the mid 1800s, 130,000 employees, 25 billion in revenue. Tilray was founded in 2013. This was I think it's a year or two later. They had 330 employees, 28 million in revenue. This little company. I've made a fortune in stocks that are flash in the pan. Okay, so again, discounting. This is why price is so important, and not to get hung up on, well, I'm going to buy this quality stock and the earnings are good, the fundamentals are good. Well, even if it doesn't go down precipitously, even if it's not a stage 4 decline, it goes down 60, 70, 80% and stays down, it may not perform. It may not perform well. You want to be where the money is, where the money's going, and that's where price always overrides. Now, not only do big earnings fuel price, but acceleration. And now an acceleration can be from negative earnings becoming less negative to becoming positive, where positive earnings become more positive. And this is just a hypothetical example, but these would be quarterly earnings that are sequentially your year over year results, and they're accelerating sequentially. So you would compare the previous year to the current year to the previous year, and then sequentially moving forward. What I look for is to see if there's any in the last 4, 5, 6 quarters, if there's any acceleration in the earnings. And also I'll look forward 1 or 2 quarters, because 1 quarter, even 2 quarters, the street can get a pretty good idea of that. Even though it might not be totally accurate, the further out you go, the less accuracy you're going to have. You can get some accuracy out a quarter or two, and you can see not only if there's acceleration on the table, but if there's some acceleration that is expected to happen. So this is another thing. When you go back, remember I talked about the 95% club? When you go back and you look at the big winning stocks, 95+% of them had some form of acceleration in the previous 8, 10, 12 quarters. So you always want to look for acceleration. You also want to look at for earnings and sales accelerating. Again, if you get the earnings and the sales accelerating, we're going to look at profit margins too. That's where it becomes even more powerful. Okay. And again, in that stage 2 uptrend is where you're going to see this, and then the stock will top. And sometimes you just get blasted on earnings and it tops on bad earnings, and the earnings come in coincident with the top. Most of the time, the stock discounts it on the downside. Just bringing up a few here. Matter of fact, I'm going to bypass this. This is one that I bought right here, coming out of a nice big base here. The earnings, if you can see here, take a look at these earnings: 41%, 117, 48, 283. So you might say, well, that's not accelerating perfectly, right? Or even the sales, 29, 49, 31, 56. Well, what I'll do, and this is what I saw with Facebook, where I'll look at a 2-quarter average also. And this, again, this is if I'm doing analysis that I'm trying to hold for a bigger move and really trying to see sort of the bigger trend that's taken place. If you took a 2-quarter average of Facebook, you had a little bit of variance quarter to quarter, but they're very huge earnings: 58%, 108, 82. Yes, you had a little deceleration, but again, if you're having huge numbers and your 2-quarter average is accelerating, you're not worried about these small variances in between. So you look at the 2-quarter average: 6%, 29, 83, 95, 132, 152. It's no wonder that this stock underperformed here and then outperformed here. Just look at the drastic difference in earnings, and then you see the drastic difference in stock price. You're going to see all these big movers that I'm showing you. They're driven by earnings. Now, biotechs are driven by an expectation. So again, like I said before, you may not have the earnings on the table, but when we look back at the biggest winning stocks, upwards of 70% of them had earnings on the table. In the most recent quarter, you had earnings of 20% or greater. So you don't have to speculate. You don't have to guess and know if the earnings are going to come out good. You want to look for them already on the table. Annual earnings it's going to translate into annual earnings, and you'll see an acceleration there too. And going back to Mark's point, where even in a bad market, you can have a stock that does really well. Here's a perfect example. We saw this before with Apollo Group. This big move took place during one of the worst bear markets in stock market history, the bear market that started in 2000. And look at this stock price. And you can see the annual 28, 30, 40, 55. You've got acceleration in earnings. This is what Mark talked about of a stock being in its own earnings cycle. All right, to drive this point home a little more, and then I'm going to show you a couple specific techniques or tactics to apply to earnings. I want to talk about Home Depot, and you just look at the contrast, okay, between, there's three things I want you to look at here. First, when the stock did really well. If you take these earnings, you had an average of 24% earnings growth per quarter leading up to this big move. When we got into this big move, which was, I'm sorry, per quarter, this is annual, we're on annual earnings. When you got into this big move, you had 37, 41% years, you averaged 39%. Big acceleration. Now, when you look at after the stock topped and it underperformed for 7 or 8 years, the average annual earnings are 15% versus 27, almost half. They're almost cut in half. And again, you can see how the bad news comes in way out here, years and years later, where you really slow down. There's an intelligence in the stock market. There's a real intelligence in the stock market, and this is something to fully understand. All right, so let me show you. We talked about how I was gonna tell you how institutions, what they're looking for, and what's going to attract that institutional money. One of the things that is a very simple way you can analyze earnings is to look for what we call a breakout year, and this is done by computers. You know, a lot of these quant funds will do regression and look for, you know, certain periods of time where the earnings are in a channel, and when those earnings start to break out of there, or even the estimates start to break out of there, that will initiate interest and some buying, because that means that you know something has changed in the company. So looking for a breakout year is very simple. You're going to look for stocks that had a period where you were dormant in your earnings, and they just maybe went flat or were really moving up just slightly, and then all of a sudden there's this breakout of that range, and that's something that should get your attention. And again, the key is that none of these things I'm telling you is going to be one particular magic thing that, you know, this is going to be the reason you buy. These are all elements that you're going to put together to build a case for a stock that you want to be, whether you should be purchasing or not. And again, even with all these fundamentals, if I see the breakout year, the quarterly earnings accelerating with big earnings, I'm still not going to buy it. If it's not in a stage 2 uptrend, I'm not going to buy it. If it's not coming through a buy point that meets our criteria, which we'll show you later, I'm not going to buy it. So all this is great to have on the table, but once again, we're building a case here, okay? We're building a case, and we're also getting an understanding of what type of company we have here and what to expect. So this is how we put this together, or how I put this together when I bought Gilead. Gilead, as you can see, I'm buying it right here. And again, we're going to get into technical analysis later of why I'm buying it here and exactly the setup, but I'm buying it here. You can see, if you look at the quarterlies, 4% earnings, 15% revenue. Next quarter, 10% earnings. We doubled. 21% revenue. We accelerated. Next quarter, 208%, 97% revenue. Huge acceleration. If you just go back 2 quarters, you went from 4 by 15 to 208 by 97. All right. And again, breakout year right here. Last 1, 2, 3, 4 years, barely any movement in earnings, very slightly up from $1.85 to $2.04, almost no movement. And all of a sudden, $8, right, is an estimate. And part of that is already coming true right here. You're getting this big earnings. And that's what ignited the stock. Now, again, we don't know how long this is going to continue. And it may not continue very long. You may not have. That's the big $64,000 question. We get everything on the table here, but now it's a matter of, are they going to continue to deliver? And if they continue to deliver these big earnings, you can see the next quarter was 372% and 136% in sales. So remember, we used 100%, and that took $100 to, what was it, 256 times that. Okay, well, this one quarter is almost 4 of those in one quarter, right? The previous quarter is 2 of those, 200% moves, right? So again, you can get there even quicker with these giant earnings.
Mark, I would just add too, this is what creates these powerful trends, because to our point from the last section about the institutions, they're in that slower moving, ship. So they have got to revise their models, and they can't move nearly as quickly, which is why they're buying these dips and pullbacks and creating these strong trends as this fundamental information is ahead of them. It's rapidly getting ahead of them.
Great point. Great point. Why? The question is, then why isn't this stock just taking off, and everybody knows this and everybody can see this? Well, first of all, not everybody is knowing all this. That's number one, and puts it together properly. Second of all, not everyone is executing it properly. And again, the institutions, as Mark said, are moving slowly. They're moving slowly. Not everybody's coming in at that one time and that one point. There's lots of information. There's lots of academic and studies and things that are built on very faulty principles in the stock market. Not everybody is good at this. I can assure you, even at the highest, most professional level, most people are very mediocre. This business is no different than if you were a lawyer, a trial attorney, a basketball player, a baseball player. There's only a handful of superstars. All right. So why is the reason? Because you're not going to get all the elephants through a keyhole. That's number one. And all the elephants move slow. So the advantage that you have is that you are smaller and you can move quickly. And with your smaller size, you're not going to move the stock. So it's not going to price everything in. What's going to price things in are the big institutions, the big money. That's what's going to make the stock efficient, and that takes time. Those big moves take time to develop, and many of these institutions get in late. They're buying later within the trend. That's what keeps it going. But we'll get into more of that. All right, so let's talk about something like a turnaround situation. Okay, this is where you would apply acceleration a little bit differently, because what's going to happen now is you're usually going to be having negative earnings or very mediocre earnings. So you're comparing against what we call easy comps. And as I pointed out earlier, when you have those easy comps, now an earnings report that might look good going against normal comps or difficult comps isn't really that good. 30-40% earnings increase may not be that good. This is where you want to see triple digit if it's a turnaround situation. If you have a company that came on hard times, maybe you're in a recession, and now there's these really easy comps. They reported a penny a share per share last quarter. Well, if 5 cents now is 5 cents versus 400% increase. That again, it needs to be very large numbers now. So there's 2 ways you would look. You would look for the acceleration versus and the comparisons versus these easy comps to be very large numbers. But more importantly, you look at the growth rate. All right. So you can get an acceleration in growth rate. So stock's been growing at negative, maybe in this case, we're talking about a 5-year growth rate of -7% or a 3-year growth rate of 12%. And suddenly you're seeing this acceleration. You're getting the quarterly acceleration, but you look at the growth rate and you say, okay, well, this is actually accelerating versus what it's averaged over the last couple, 3, 4, 5 years. That's another form of a breakout. So again, this concept of breakout, you want to be aware of that. This next slide there should be 5 golden nuggets. Well, actually, there is a golden nugget over here. There should be 5 golden nuggets on it, because it really, or these next couple slides, actually, they really tell a big story here and really drive home this point that we've been trying to make here. So let me explain to you about this slide. You can see it says from 2013 Master Trader Program Workshop, which Mark, I believe you were at that one too. You've been at everyone, I think, right?
I missed one or two. I think I missed 2012. I missed one or two in the early days, but
Oh,
everyone.
that's right. Yeah, I remember you did miss one. So in 2013, what I decided to do was at the Master Trader Program, I just picked a stock, like I think it was a week or so before we put out the workbook, and I said, let me just pick a stock that looks like it has good criteria and something that I would, buy here, and I would recommend as a stock to buy. So I put this in the workbook, and I said, what I'm going to do is I'm going to show you a stock, and then a year later, I'm going to go back to it, see how it performed, and but just show what I'm looking at here. So just breaking down this chart, this is using this is actually, you can see we didn't even have MarketSmith back then. We had Daily Graphs Online, which is essentially MarketSmith. MarketSmith is even better, just an improved Daily Graphs Online. So if you take a look at a couple things, look at the growth rate. Right, the growth rate right here is 4%. I want you to take note of a few things. You could maybe even write this down on a piece of paper, because we're going to move off this slide in a second. The PE is 21, right? Okay, your earnings here, your earnings are averaging 29%. You can see you got some acceleration versus the last 3 quarters. You're 11, 19, 18, now 13, 30, 17. You got a little deceleration, but you're averaging about 29%. Pretty good earnings acceleration right there. Positive sales, nothing really big. Let's see here. Let's look at the. We have a breakout year. You see, you're really kind of growing. Not too strong, but you got these breakouts here coming. Okay, and the relative strength is 90. You're in an uptrend. You're in a stage 2 uptrend, and you're coming out of a well-formed base. So you've got a number of things here that look pretty good, right? But here's what I want to show you. This is what's really important. So now, when we see the stock here, it started at a relative strength of 90. This right here is where this chart starts, right here, okay? Right here, there from the previous page. So it did pretty well. It had a pretty good move. I don't know how much it went up here, but it's on $60 to maybe 90 or so. It had a nice move. Let's look here. Now that we're a year or so later, or about a year later, the relative strength is actually lower. Okay, that's the first thing you want to look at. The relative strength is an 85. So high relative strength. Some people think, well, I'm going to buy a 60 relative strength because I want to buy it before it becomes a 90 or high relative strength. Why would I buy it at 99 when I can buy it lower? Well, that doesn't mean relative strength is relative. A stock could be moving sideways or going down, just going down less than the market, less than the rest of the stocks in the market, and you'll have a relative strength that will be high or be moving up. So relative strength, you always want that number to be strong now, currently, and the stock can go up, and it might go up less than its peers, and at some point in the relative strength come down. So that's the first thing to know. But we're on earnings now, right? And fundamentals. The PE ratio, the growth rate was 4%. Now it's 23. You see, drastic acceleration, big acceleration in growth rate. And that was only 1 year. 1 year affected the 5-year growth rate that dramatically. Now, the stock went up, not 100%, but a pretty good move. The PE is unchanged. Just like we talked about in valuation. And this PE could have been 90, could have been like Yahoo, which was 938 times earnings. And then we look later on, and the PE was 1700. It expanded. It could be where you go and the stock goes up 200% and the PE is actually lower. It's a better valuation at a higher price. Why? Because the earnings came in. See, the earnings came in, and you can see here the earnings. You have, with the exception of 1 quarter, you had strong earnings growth. Now, here's the real key to this whole thing. If we go back here, and this little red circle is just showing these estimates right here. The street was estimating that in 2013 you'd have $2.97, and in 2014 they would report $3.37. But what actually happened was 307, okay, was better. And in 2014, it was 376, much, much better. What this shows is that, again, the limited visibility. Now, this is with pretty small numbers and only 1 year out, an estimate 1 year out. So if you were to go out even further and say you went out 2 years, 3 years, the accuracy is going to go off a cliff, and they're going to be nowhere near what actually happens, up or down.
Mark,
And
I want to make the point too that this is a huge company at the time. I mean, Home
Right.
Depot is a big stock, and this is still what's ultimately driving that big move. So my point is, this is what is going to drive institutions to names. But if you take the same idea to mid and small cap names, this is where the prices can be and moves can be much more powerful. I think, yeah, I'm reading that right. $120 billion market cap. I mean, this company was no secret, and yet still had a powerful move once those numbers started showing up.
But what Mark is saying is that there's a whole bunch of analysts that follow this, teams of analysts. Fidelity probably has 20 analysts following this thing before they buy it, and they can't get it right. They can't get it right. That limited visibility, that conservative nature that we talked about, it applies to these big companies. But when you get to a small company, as Mark just said, this is magnified. And now you get to a small company that doesn't have many analysts following it, isn't followed very much and priced properly, and you've got large numbers. Now these big earnings are coming in, so now it's completely mispriced, and that's how you get these huge moves. All right,
Golden nugget right there.
absolutely golden nugget. And now we're going to look at it in the opposite direction. Okay, we're going to look at, because a year later, when I came back to the Master Trader Program, right here, I said last year, I included these slides, and I said last year I picked a stock, and this is what happened. And this year I'm going to pick a stock to avoid. And then a year from now, we're going to look at that, and we're going to see. And I picked Lumber Liquidators, which was a previous market leader. If you remember, we talked about this. This was a market leader in this uptrend here. I actually bought this stock. Unfortunately, I got shaken out of it. I didn't participate in anywhere near the amount that I should have. But again, I was in this, buying this as it was emerging, as a leader here. And then it went to stage 3 and stage 4. And I noticed this, and I said, okay, this is the stock I'm going to pick as an avoid, or even a short. So again, we're going to apply the same thing. We're going to look at the same analysis as we just did, but we're going to do it in reverse now. Okay. So let's look at the relative strength. It's a 3, right? Take note of that. The PE is a 22. The estimates are for minus 4? I'm sorry about that. Minus 4%, and then 21% gain in 2015. You can see earnings here in the current quarter were down 14%, down 18%. Now let's fast forward a year later. And again, when we were doing this, we wouldn't have the benefit of the hindsight until a year later. We took a look at it. So estimates were for 2014 to be $2.67, and in 2015, $3.22. Let's look at what actually happened. Well, in 2014, they were off by a bit, $2.31, right? But now, fast forward one more year, and here's where the visibility goes down the tubes. Instead of $3.22, they lost $1.20, just a little off, $4. So again, now here's another key. The P ratio here is 22. The stock gets clobbered and goes down like 90%, and now the PE is 86. How is it trading? How is it so much more expensive when it came down so much? Because the earnings. See, the stock is going down, but the earnings are going down more, faster. And if you have negative earnings, you don't even have a PE ratio, right? Look, and you can see here, look at how the earnings, they just evaporated. And all the bad news comes in later. And look at the sales. You got the negative sales didn't come down for 4 quarters later, then the negative sales come in. Again, that limited visibility, you see, and this is where the opportunity is. This is where this slow moving Wall Street and being able to adjust to these numbers and just not having the coverage. These are the smaller companies just don't have the coverage. And even we look at Home Depot, you look at Coca-Cola, Microsoft, thousands of funds owning them and following them. They're swimming against their own tide, because even if they get it right, there's so much supply, there's so much ownership that it's already over-owned. there's not much firepower anymore. Everybody owns the stock. So there's a lot of reasons behind this, but this is the concept that you have to understand. So I'm not going to go over this. There's a few things on here that you just are for your own edification and you can take a look at, but this is some tips on how you can measure an earnings report to go beyond the number reported, to know if it truly is a good report. The main thing is that you need to gauge three things. One, the initial response to the report, your subsequent strength, because sometimes you sell off a bit on earnings, and then a day later, stock starts taking off and it holds up relatively well, and also the resilience of whether it can snap back very quickly from a pullback. That price action. This is where the differential disclosure comes in. Compare the news, the earnings, the sales, the report to how the stock price is acting. Not only on a longer term basis, see if it's an uptrend versus a downtrend, but also even on an earnings report, what is says to be a surprise. They come out with 10 cents above estimates, but the stock's down 20%. That's not a good earnings report. Okay, that's not a good earnings report. All right, let's move on to profit margins now. This is the third piece. Now everything that we just talked about, it sounds like a lot, maybe, and after profit margins, it's going to be even more here. And it might sound like a lot to say, wow, this is a lot to understand, a lot to put into use. No, it's really not. It's really not, because you just need to understand this concept. The tactics that I'm going to show you and I'm giving you now are quite basic, but they're powerful. Okay, with the simplicity comes power. And then the real key is stacking them, using all these things together. And that's the true essence of specific entry point analysis, is taking all of this and building all the probabilities to where it all comes to a fine moment where that is the moment to purchase at a high probability, low risk entry. So we're going to talk about profit margins now. And again, I'm going to give you some perspective here. Tell you a little story here about a made-up company. And this is a little company that we're going to make up. We're going to call it a grocery store, because grocery stores have very low margins, and I want to make a point here with margins. Let's just say it's a little mom and pop shop. This could be 10 million, it could be 100 million, doesn't really matter. I'm just going to use revenue of $1 million. Profit margins of 1%. The market cap of the company is 100,000 shares. So if you take $1 million in revenue times 1% profit margins, that equals $10,000. You divide that by 100,000 shares, you get 10 cents per share. That would be your earnings. If this was a public company or whatever, you would have 10 cents per share based on this information. So let's say that we're going to give two scenarios. The first scenario is that revenue is unchanged. Okay, the revenue is unchanged. I'm sorry, the profit margins are unchanged, and the revenue is up 25%. So you've grown your revenue. You've gone from $1 million in revenue to $1,250,000, but your profit margin remains at that 1%, right? So your earnings are obviously going to be up. They're going to be up 25% because you're at the same profit margin, and your revenue is grown. So that pushes your earnings now. That 1.25 million times 1%, it gives you 12,500 divided by 100,000. You've now got 12.5 cents per share, right? Your earnings are up. Okay, great. Not a bad report. But scenario B is you're going to have the same revenue. Okay, revenue is still up 25%. Only in this scenario, you're going to increase your margins by just 1%. Okay, now, with a company like a grocery store that has very low margins, something like a Walmart or a grocery store is operating on, depending what period, 1, 2, 3% margins, very low margins. They operate on volume, right? So a 1% increase in margin that sounds so small, it actually doubled the margins here. So now let's run that same scenario. Revenue's up 25%. Right? That's that 1.25 million, right? But profit margins now go up 2%, just 1% more. Let's do the math. You take the 12.5 times 2% is 25,000 divided by 100,000 shares, 25 cents per share. Now earnings are up 150%. You got triple digit earnings, all from 1% margin increase. Now, how about if we grew revenue too? I'm not going to do the math. You can do the math. Grow revenue by 50%, 100%, and apply that margin. This is, again, how you get stocks. How can a stock go from $10 to $100 in a year? This is how. This is how. And when you put all this together and you have an understanding of it, you can start to understand what's going on and how to get there fundamentally. Now, let's look at a real life scenario, okay? Because this is a stock that I was buying and David Ryan was buying around the same time. There's a perfect example to make this point. You look at Ollie's, and this chart, actually, I don't think we have it credited, but it's from Value Line. It's one of the Value Line tear sheets. So they reported 50% earnings in this year in 2016. Their revenue was up 16.8%, and their margins were 6.7%. So versus the previous year, which was 4.7%, that was a 42.6% increase in margins. So the real story behind this, even though earnings were up, that would certainly fuel. Even though revenue were up, that would certainly fuel earnings. A 16.8% increase in revenue would produce an increase in earnings if the profit margins were the same. But the real power behind this came from the combination of the two. When you put the margins in there, that's what boosted it, and you got those 50% earnings. Let's take the margins and just keep them unchanged, okay, which would still be, they're growing the company, it would be fine. So without the profit margins, now you've got, that was 4.7% versus 4.7%. Earnings would only be up 7.81% now. See, so the real power under the hood were the profit margins turbocharging. Now, let's say that revenue was up 100%, and even margins are up 10 or 15%, 20%. Again, you'd have these explosive earnings. You would have huge, enormous earnings. And this is what can happen. I'll show you some more examples. This is what happened with Apollo. We're going to go back to Apollo. Remember, I told you, I'm going to keep showing you a lot of these examples that I showed you previously. I'll show you in the stage analysis. So you'll see the 1, 2, 3, 4 stage, and you'll see it's in a stage 2 uptrend. Then I'll show you in the earnings, or maybe in the comparison to the market, to show you how it was a market leader versus the market. Then I'll show you in the earnings and the sales. And now we're in profit margins. So you're going to see how all this is built into these winners that I'm showing you, that I participated in, and some of the better names, and how this all chronologically, we put this together. And then when it's all done, you'll have that full puzzle with all the pieces in there, and understand how they all fit in to this one big picture. And it won't seem so overwhelming. So again, look at the net profit margins. They go from 11.7 to 14 to 16 to 18.4. You've almost doubled your profit margins. Huge, enormous. If you apply that to even flat revenue, which they had revenue up, that would really grow. That would really grow the earnings, and that's why the stock was up 850% versus at the Nasdaq down 60%. So even, as Mark mentioned before, even in a tough market, these stocks are in their own earnings cycle. Let's look at Panera Bread. This is another name that I was in early on, 2000. You had 4.7% margins like Ollie had in 2000 to 2001. They went up to 6.5. Then they went from 6.5 to 7.8, from 7.8 to 8.6 on big revenue. This produced an 1,100% return on the stock advance versus the Nasdaq down 80% during that period. And again, we're not going back to like say, hey, I was in this stock and look at me, I picked this stock. We're explaining to you for you to understand the concept of what drives these prices. And now, if you can participate in these type of fundamentals in companies that are in a bull market, then you have, not only you have an incredible opportunity in these individual companies, but in the overall market, there will be lots of opportunities. And that's where you can really make a lot of money in a lot of different areas. Monster Beverage. Remember I said, if you go back, you look at Coca-Cola in the early 1900s, no difference. Profit margins improving, sales ballooning, led to big earnings, big stock price. 2003, sales up 20%, margins went from 3.3 to 5.4. You go to 2004, sales are up 63% now, right? Acceleration, big acceleration, but earnings turbocharging it. Double, I'm sorry, net profit margins double. Profit margin double. Gross margins double too. 5.4 versus 11.3. And now you go to 2005. No wonder the earnings are up 197%. Sales are up 93%, and margins went from 18%, I'm sorry, from 11.3% to 18%. Again, go back to 2 years earlier, from 2003 to 2005, you started at 3.3% margins, the margins of like a grocery store. And then a couple of years later, you're at 18%. You're at margins of a high-tech software company.
This is Mark. This is a perfect example of the point we were both making. You know, Home Depot, yes, strong move, but same principle on a smaller cap stock. This stock went up 10x in 18 months. This is because, to your point, there weren't as many analysts covering it. The market is discounting a massive amount of growth very quickly. And this was a fad for those of you who remember when the monsters first started coming out. Everybody was buying them. You know, I mean, I used to work with guys who would drink 3 or 4 of them a day. You know, it was that beginning of that energy drink type of thing. You can't price in the earnings growth fast enough, which is why this stock is just absolutely on fire.
Absolutely. And one of they call it the great turnaround is Apple. Apple is a profit margin story all the way. And that was because they came out with this product that they refined. They refined the development of it and the production of it, and they had pricing power because they had this phenomenal product that nobody else had that was life-changing to the world, and they had pricing power. And if you go back and you take a look at when Apple started faltering, you'll see that the profit more the on the street, Wall Street was talking about how they're losing pricing power. You came in and you had Samsung and other alternatives, and there's the competition, and then of course Steve Jobs passed away, and there hasn't been much innovation, and now they're losing some of their pricing power. So you have to have a choice. You're going to either lose volume or you're going to lower your price, and your margins are going to contract. Either way, it's not good. But the great turnaround was driven by this wonderful product that was selling like hotcakes and an expansion in profit margins, pricing power. Again, if you go back to the very beginning, remember what I said, there was 2 scenarios. The best were you had pricing power, you had growth, you had strong scalable businesses. The worst case scenario was limited pricing power, big regulation, cyclical industries. Just the opposite. Apple had all those things where you had an unregulated area, you had a new product, scalable, a huge market, explosive market potential worldwide, and profit margins or a result of pricing power. So, but look at these numbers. You started in 2003 with 1% profit margins, and they expanded consistently all throughout the decade, pretty much up to where you were at almost 24 times the original margin. You went from 1% profit margins to almost 24% profit margins. I mean, that is, colossal. And that's why you had a colossal stock. All right. So now the real power in this is to put them together. And I told you a couple things. One, how you can turbocharge those earnings and the revenue with the profit margins. And you can look for this, of course, you want to find stocks that have these characteristics. We talked about in the very beginning on how there's computer models, there's quant funds that are looking for this stuff. And basically a very simple approach is what I call using what we call the code 3 matrix. A code 33 is how we term it, when you have all 3, you have earnings, sales, and margins all accelerating over 3 quarters. That's sort of your best scenario. That's like a really strong scenario that you want to focus on. If you have 2 quarters, okay, then you would go from a 33 to a 21. And if you go down to 1 quarter, you would have an 11 and so forth. You can see the matrix here and how it's laid out. So now if you had 1 quarter of acceleration and you saw accelerating earnings, that might be something that you start watching, you see if there's another quarter, if the stock's acting well. It doesn't have to be 3 quarters. You can have just 1 or 2 quarters, and you'll live with it, and maybe you'll buy that stock if it meets all the criteria properly, technically. But this is what you're looking for. This is what you're looking for. And the longer that this goes on, where you get this expansion, and the more you can get it across the board, where you're expanding the revenue and the profit margins, it's going to lead to expanding earnings. And again, you can look for differential disclosure. You see a code 33, it's got earnings, sales, margins, everything's expanding. Fundamentals look great, big giant numbers in the current quarter, right? But the stock is in a stage 4 uptrend. What does that say? That says that you can throw all these numbers out the window, because guess what? Differential disclosure. The price is discounting. It's discounting something is up there. So they got to agree. Okay. If there's the things that you have to come away with this chapter are not secret formulas where, oh, I'm going to look for a breakout year and buy all the stocks that have breakout years. No, this is all evidence to build a case. And then what's very important is to gauge against the price action. And does it make sense? Is the picture coming together where you have all the evidence? So when you have all the evidence, that's a stock that you're going to consider. And then we still there's a lot more that we're going to be a technical analysis and so forth. But this is the basics around, or I shouldn't even say this is the basics. This is everything. There's nothing more. I don't do anything more when it comes to fundamentals. This is it. I don't look at anything else that is really affecting my decision. I'm aware of, I can see the, return on equity and various metrics that are laid out on a MarketSmith chart, but this is what I analyze and affects my decision. I just become really, really good at analyzing these few very important metrics, which, like I said before, there's a million things not to do. There's only a few that you have to get down and master to be really great at this, and that's what you want to focus on. Let me see here. Just ending this section. So again, I'm not going to go through this. These are just some things to watch: earnings, sales, and margins, positive and negative. Just recapping some of the things we talked about. Mark, you have any final points here? We're going to take a break here in just a minute.
Yeah, I was just going to say, this really is kind of, like you said, the bedrock in terms of the fundamental work I do. And the nice thing about MarketSmith is it's all right there in one window for you. They didn't used to have the margins. Now they even have the margins. I think thanks to you, or you pestered them enough where they added it a few years ago, where you didn't have to go somewhere else to get it. And you can, you looking for those breakout years, as things set up, it with what we're going to get to next, it just, you're stacking probabilities on top of each other, and you don't have to worry about getting on earnings calls and looking at balance sheets. I don't do any of those things. I just look precisely what we talked about, say, over the last 45 minutes.
Yeah, and a couple of things. One is MarketSmith. I'm not sure if it was because of David, Ryan, and I, but we did lobby for profit margins to be put on the chart for a number of years. We made that suggestion, and then they showed up. So again, I'm not sure if we had anything to do with that, but what matters is that they've got all the information right there. That's why I've been using the product for, and that's why they're our sponsor, because I don't not because we're paid to say MarketSmith's good, because I've been using the product for 30 years and I love the product. It's the category killer. So again, it's all laid out there. Another thing is that all this information, all right, that we're presenting here, again, is not necessarily where, again, there's any one secret thing, where you're going to, like I said, look for the breakout year, acceleration. These are all elements to all bring together and to create. There's a lot of subjectiveness involved in this, and it's a skill. There's a skill in putting this all together, and it may seem like there's a lot here, and there is, but it's a lot simpler than you think. It's a lot more straightforward than you think. And the more you remove all the moving parts and you bring it down to the elements that I'm going to show you, and you master them, you spend a couple of years doing this. And is it worth 3, 4, 5 years to get to a point where you can do really, really well in the stock market and have this unlimited opportunity, an opportunity that literally completely changed my life from being as poor can be, to a multi-millionaire in a very short period of time, and a decamillionaire shortly after that. It completely changed my life, and many people around the world that are our members, our customers, our clients, and so forth, and those who have read my books. So it's going to take some time, but it's well worth the investment. It's well worth the investment. So if some people get this far and they're already overwhelmed, and I assure you, by the time we get to another day or two, your head is going to feel like it's swollen. It's going to just explode. But we'll get you there. All right, hang in there with us. We'll get you there. And for those of you that are advanced, and maybe this has been simple to you, I assure you it's going to get more complex, and there's going to be a lot of enlightening moments. So we're going to take a break now, and then we're going to come back and finish up today with getting into some of the technicals, a little bit maybe more fun stuff for some of you, and we'll get into that when we come back here. We're going to take a break just for a little bit. Okay, we'll be back.
All right, guys, I know Mark was just talking about the amount of information, and it's getting more, but I can imagine a lot of you are getting a bit overwhelmed right now. I'm getting some comments here, appreciating all the information and comments. So let's just take a 5-minute break here. Then we're going to have the final session of the day, being Picture Worth $1 Million. So be back in 5 minutes. Try to do perhaps 10 push-ups. I like to get the blood pumping, get your brain flowing. See you in 5.